All right, picking up where we left off. So, here's the twist. Because if you expected gold to explode higher during a war escalation, that didn't happen. Gold and silver had surged to historic highs before the conflict widened, but over the last 24 to 48 hours, they pulled back. Gold down roughly 0.9 to 1.4%, silver showing similar weakness. This retreat accelerated between March 2nd and today, March 3rd, and that surprised a lot of traders. And who's rotating? Gold traders, safe haven investors, macro desks, and here's the key. Capital rotated not into metals, but into bonds and cash, ultra-safe positioning, treasuries, short-duration instruments, liquidity preference over commodity exposure. So why is this happening? War increases inflation expectations. Higher oil pushes capital costs up. Higher capital costs make non-yielding assets less attractive. Gold doesn't produce yield. Bitcoin doesn't produce yield. When rates are expected to stay higher for longer, yield-bearing assets win. That's the mechanical explanation. Now this is where the debate gets loud. If gold isn't acting like a safe haven, Bitcoin won't either, at least not immediately. The digital gold thesis doesn't activate during acute liquidity shocks. It activates after stabilization. Right now, Bitcoin is trading like a growth asset, not a bunker asset, and gold just reinforced that reality. This adds fuel to the bearish narrative. Critics will say, see, Bitcoin isn't a hedge. But here's the nuance. Safe haven flows happen in phases. Phase 1, cash and bonds. Phase 2, selective commodity flows. Phase 3, alternative hedges. We are still in phase 1. So what happens next? If de-escalation headlines hit, gold likely rebounds. Bitcoin likely rebounds harder. If conflict persists and inflation expectations remain high, metals could flip higher again. But until rate expectations stabilize, yield dominates the conversation. The safe haven story is not dead. It's just early. And in early war volatility, cash wins.